Hey everyone, welcome to episode 37 in my monthly series where I'll give you a quick update on the overall stock market in the past month to see which sectors are undervalued in my opinion, which have lagged and presenting a good buying opportunity. And then I'll review some of the most popular high yield income oriented covered call funds on both the Canadian and the American stock markets to see how they're doing, if there's any changes, and I'll tell you which ones I feel are good buys this month. If you're new to the channel, welcome aboard. This channel and my investing strategy focuses on a long-term buy and hold income-oriented approach or income-oriented strategy. So the primary objective of the strategy is to generate relatively safe, consistent, passive income forever. And one important factor of my strategy is to invest consistently over time. If you do, you will capture what is undervalued in the stock market, dollar cost average, and keep growing your income stream over time, ultimately always beating inflation. So I do not invest in single stocks or single companies anymore, with some minor exceptions. So all the picks will really be funds or ETFs, closed-end funds that are really designed to provide that high yield and passive income. So they're essentially income oriented, not growth oriented. So all of them have income enhancing strategies like covered calls, like leverage, and most of the time a combination of the two. Remember, I am not against the more mainstream growth strategies or dividend strategies. Those work really well long term as well, but those are more designed for investors that are prioritizing total returns over time and growing and sustainable dividends, whereas my strategy is really designed to maximize your monthly cash flow. So let's check out what the market did in the past month. It was pretty turbulent, especially on the US side with the US banks. There was some news there, but I'm looking at the past month on the S&P 500 and it's up 1.33% in the past 30 days. So the S&P 500 is obviously a lot tech heavier than financials heavier. So the US market or the American market has done pretty well in the last month, whereas the Canadian market, by the way, I'm filming this on April 4th. If we look at the TSX Composite Index compared to the S&P 500, which is up a little over 1% in the last month, the TSX Composite Index is down 1.23% in the past month. Again, very financials heavy, very energy heavy, and energy and financials took a little bit of a hit. Even though most of the bad news was all on the US side, the financial sector typically all follows each other. So it's going to be no surprise that in this month, the sector that I'm going to be most interested in is finally not tech, or I feel is undervalued. It's finally not tech. Tech has been doing pretty well lately, but it's financials. Financials has been put under pressure, presenting us, investors who invest consistently a great opportunity. So we'll take a look, or I'll focus a little bit more on the financials ETFs, which I feel are good pickups. So let's check out the picks of the month. Let's check out the most popular funds now. We'll start with the Canadian market and then we will do the American market. Before we continue, I'd like to take a quick moment to thank the sponsor of this video, Brompton Funds, a Canadian income-oriented fund manager, which recently launched their own all-in-one enhanced covered call ETF. Of course, I'm talking about the Brompton Enhanced Multi-Asset Income ETF. The stock symbol is BMAX. It's a monthly payer, approximately 10% yield right now, and it's very, very diversified. And I think out of the 4 all-in-one covered call ETF solutions that we have now on the Canadian market, it's the most defensive, it's the most conservative because it has 70% in equity and 30% in fixed income. So I strongly suggest you guys check out the breakdown on their website. The link is in the video description below. All you have to do is click on portfolio and you could see how really well diversified and defensive it is. All right, guys, starting with the Canadian market. Of course, we're going to start with the big five, or the ones I call the big five core positions in my personal portfolio. These are the diversified all-in-one style of funds. And we're going to start with HYLD because we do have some news here. HYLD has been slowly recovering, going up in stock price because it's very tech heavy. It has a nice chunk in gold there, and it is going up as well because of the instability. Remember, guys, instability equals people go to gold. That's just how it is. And I just want to show you that there is big news here for HYLD because they just made an update yesterday, and I am filming this on April the 4th, and you see that they added 2 brand new ETFs in here, QQCC and USCC from Horizons, and they cut the QYLD and RYLD exposures in half. So if you didn't know, Horizons and Global X, they're under the same company, so they're kind of like brother or sister companies, but Now we actually have, I really like this move because we have even more strategy and fund manager diversification. So when it comes to the NASDAQ, we have JEPQ from JP Morgan, we have QQCC from Horizons, and we have QYLDs. Really, really awesome. And then they did reduce the RYLD in half, and they added USCC, which is another covered call ETF from Horizons, which has really nice high yield, and it's more of a diversified US large cap. So I would compare USCC pretty much to a JEPI or an XYLD. Think of it more like your S&P 500. So we have 10 covered call ETFs total. And to be honest, guys, I don't know if they're going to leave QYLD and RYLD at these percentages or eventually sell them off completely for these two. This is why I am in contact, as you know, our good friends at Hamilton ETFs, and we are trying to schedule or plan another Q&A to discuss these changes. But I have a strong suspicion that they will be releasing a press release to discuss these changes in HYLD and H-yield and the reasoning behind them. So keep an eye on that press release. But in terms of HYLD, it just cracked $12, so it's no longer 14% yield, unfortunately. But it's still a very, 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 very high yield and definitely a good all-in-one solution for your American exposure. Of course, HDIV is the opposite. It's more for the Canadian exposure. So HDIV went down a little bit because it's very financials and energy heavy. If we scroll down, we could, you guys know it by heart now. They have, HMAX and HFIN for the financials, a big chunk in NXF for the energy. So HDIV, a great time to pick it up as well, because financials, like we said, is under pressure, and this is very financials heavy. It's actually the biggest exposure here at 30.7, but keep in mind it is Canadian financials, and what really suffered was US financials. So still over 10% yield, but I would say the most interesting all-in-one, and this is the one I've been picking up lately, if you've been following me on Blossom, you would have seen that, is HDIF. So the Harvest Diversified Monthly Income ETF. If we click on portfolio, this is also very financials heavy, but the key difference is that it's mostly US financials, guys, because it has HUBL, a specific covered call ETF, which only has US banks. So that pretty much brought HDIF down quite a little bit, not that much, but at one point it was over 11% yield. Now it recovered a little bit, but still very, very high yield, 10.7 here. So this is the one I've been picking up. But at the end of this segment, once we go through the funds, I'll show you the financials, US specific ETFs that you could capitalize more on. But myself personally, and you'll see this in the next portfolio unveil video, of course, I've been picking up some HDIF lately. So then there's BMAX. BMAX is the Brompton one, the newest one to the lineup, still doing very well. It's probably the most defensive, the most boring out of the four all-in-one cover call solutions, that has a lot of, it's the only one that has 30% in fixed income and 70% in equities, where the other three are all equities. So a little bit more stable with this one, and it's hovering around 10% yield. EIT is very financials heavy, so it went down a little bit, but that's mostly because that day the energy went down. I know energy's down. It was down. It popped yesterday, and now it's a bit more down. But EIT is always trading at a small discount, so it's always basically a good time to pick it up if ever you're looking for that. So that's it for the big five, everyone. So of course now let's go into the closed-end funds or the split funds. Do any of them stick out? Not really. Talking about the Brompton ones, SBC and LBS are really the Canadian financials focused ones. They're both trading over 20% premium still right now, so nothing that interesting. LCS is still trading at a discount, believe it or not. You would get just under 18% yield, but keep in mind it's only the life insurance companies. But it's worth $539, and you could pick it up for at $509. So it is trading at a small discount. Of course, this is as of March 30th, 2023. And if you didn't know, Brompton pretty much updates every Friday. They update their NAVs, except for GDV and PWI. These are actually done daily. So you see GDV starting to get interesting because it's the gap is narrowing between the NAV and the market price, but it's still at about 20% discount here. So we'll look at it real quick. So we take the market price divided by the NAV, 803. -1 times 100. So it's still at a 25% premium, guys. It's not worth it in my opinion, but it's certainly getting more interesting, especially, it's going to cross 12% yield maybe. So my opinion, when they start getting interesting is when they're under 10% premium. So DGS hasn't been paying for 2 months, and you could see that, it's been putting pressure on the market price here at 515. So this is probably the most interesting one. If we do 515 divided by 456 minus 1 times 100, I don't think the premium is that big. It's just under 13% premium. So maybe if at $5, it'll probably be kind of interesting for me. PWI, the premium is actually pretty small. It's worth 619, and you could pick it up for 7 at 11.41% yield. I used to have this one, but I got rid of it. I traded it for a little bit more BMAX. So that's it for the Brompton ones. The one that, nothing really sticks out to me this month for the Brompton ones. Going to the middle field ones, ENS and RS, they're both trading at premiums, but they're pretty small. So ENS is trading at about 9 or 10% premium, and the real estate one, let's just do it real quick. 1459 divided by 1306 minus 1 times 100. It's trading at 11.71% premium. So pretty good time if you want to buy real estate. If it would be under 10, it would be even better. I had picked some up recently. So the middle field ones are always the ones that have the high unit NAVs here. Over $23 for both of them. Now, unfortunately, guys, I'm sorry to tell you this, but it's April 4th, and they still didn't update their unit NAV. So I can't really tell you. The one that I was most interested in is FTN or Financial 15, because it has about 40% in the US banks and then the rest in the Canadian financials. So unfortunately, we can't really see what the unit NAV here is and compare it to the price of FTN. But with my luck, it's probably going to show up tonight or tomorrow. So just that's something I would keep my eye on, because FTN might be interesting because again, it's really the financials that's taken a hit. BK, same thing, trading at a fairly big premium, went under $20 unit now, but keep in mind BK it's all Canadian. It's just the 6 banks, or mostly the 6 banks, and it's a very aggressive, it gives out 15% annually, so it's very aggressive. Moving on to the Bitcoin and Ether yield ETFs. You guys know this is the only way I would ever invest in crypto and Bitcoin and Ether if I would be getting covered call yield on it. So they've been recovering. Bitcoin and Ether both have been recovering really nicely. It's a while I haven't seen these ETFs at these prices. Unfortunately, the sad thing is that they haven't been increasing their dividend. The last 4 for Bitcoin is just 2.1 cents. Same thing for the Ether, the last 5, 2.1 cents. My only assumption here, guys, is that they feel that there's still a lot of room to grow, and they're probably writing less covered calls on it. So I would love to talk to Purpose about these. I am still waiting to hear back from them we're going to do a collaboration on their new single stock ETFs, including TSLA, which is gaining pretty good popularity. It's over 15 million AUM, and it's had really nice consistent distribution. So I can't wait to talk to our returning champion here, Nawan Butt, who manages these funds, including the crypto ones. So hopefully we'll be able to talk to them soon, and I'll ask them definitely what's going on with, why they're not increasing the dividend. Is it on purpose? Is the volatility lower, or is it because they're writing less calls? That would be my guess. So that's the overall popular funds on the Canadian market. Now let's discuss the sector which is probably the most that took the most beating, so it's presenting the biggest opportunity. It's US banks by far. So when it comes to US banks, everyone, or financials, my top choice would be Call from Evolve ETFs or ZWK. So Call, ZWK, these are covered call ETFs that only hold US banks, and they've been taking a beating, which means the yield is much higher. So this is as of March 24th based on a stock price of 1807, but I think it's lower than that. So you could expect with ZWK, this is BMO, guys. It's very reliable. It's a very big fund here of over 200 million, about 11.40% yield, which is awesome. Keep in mind, there's no leverage here, guys. So it's a very nice organic and consistent yield. And then, of course, you have Call, which the yield is just under 13.5%. Another great option here if you really want to focus or capitalize on the weakness in the U.S. banking sector. Me personally, I kind of try to stay away from the single sector ETFs, but that's just me. I'm not saying it's bad if you want to invest in Call or ZWK. I actually think it's a good idea. But me personally, I went more with HDIF, which, by the way, the third US banks covered call ETF is HUBL. It is the lowest yield out of the three at 9.32, but it's still a great opportunity. If you like the Harvest one more, if you like the BMO one or the Evolve one, it's really up to you. Or you could just invest more or less in HDIF, which kind of gives you a little bit more indirect, safer exposure to add a little bit more US bank exposure. So the thing is with, the financial sector kind of all follows each other. So although there hasn't been any issues, any problems whatsoever on the Canadian side, the Canadian financials ETFs also have been put a little bit under pressure. So you guys know that the top ones, in my opinion, are HMAX. This is the highest yielding Canadian financials ETF. I love the fact that it's 75% banks, but there's also life insurance companies and Brookfield in here. So just under 15% yield right now. You also have Bank, which is the only one from Evolve that has covered calls and a little bit of leverage. So this one has a little over 11% yield. Keep in mind, HMAX, no leverage, but more aggressive calls. Just want to show you, see that if ZWK, for example, you see if, from $25, now it's at 17, right? If we go to call, I'm sure you'll see a very similar graph. Of course, it doesn't show up here. We'll have to go here. Call, so down 2.83%. If we just go to 6 months, you see the big drop off as well. So very big opportunity if you're opportunistic, the Canadian the US financials, but the damage kind of went over to the Canadian financials as well. So top choice if you really want to capitalize, guys, this month is definitely the financials ETF. So you have call, you have ZWK, you have HUBL for specific US banks exposure. Then you have HMAX or Bank for the specific Canadian exposure. And then you have HDIF for the indirect exposure, and even HDIV for the indirect Canadian exposure. So lots of options. It depends up to you what your flavor, what you like most. Unfortunately, the LBS and SBC trading at big premiums, and we really don't know what the FTN was the one that I was most interested in, but keep looking at it and see when this updates, and then calculate the premium or discount percentage, and then you'll figure out maybe FTN could be a great option as well. So that's it for the Canadian side, guys. Let's look on the US market now. All right, everyone, on the American side, of course, we're going to go with the big ones or the big core funds, which I would say there's pretty much 6 of them. Of course, I'm talking about QYLD, RYLD, XYLD, and I'll even add DJIA, which if you didn't know, Global X has a 4th one now on the Dow 30 index. Same strategy for all 4 of these ETFs. At the money calls on 100% of the portfolio. And I do have some great news. Stay tuned that I did speak with Global X, guys. I do have 2 upcoming videos where I will explain in detail QYLD, RYLD, XYLD, DJIA, how they work, and then I'll speak to the guy at Global X who he's not a portfolio manager, but he's the director of the income suite. So he definitely knows, he's definitely the spokesperson for these ETFs. So I'll talk to him about it. And I promise you, after watching those 2 videos, guys, you will understand 100% what QYLD is, how it works, how they make their money every month, because it's a very, very systematic approach, kind of like BMO on the Canadian side. So very, very exciting. So I don't have really anything much to say about these 4. They're doing exactly, I keep saying this, they're doing exactly what they're supposed to be doing. And also for JEPI and JEPQ, I've already announced this, but I've also having upcoming videos. These ones are going to be first, actually, before the Global X ones. I expect 2 videos where I will do a deep dive on JEPI and JEPQ, and then I'll also talk to the guy who manages these 2 ETFs at JP Morgan. I spoke to a legend at JP Morgan. This guy is actually head of options, head of derivatives, Mr. Hamilton Rayner. Super nice guy. Very important we speak to him, because JEPI and JEPQ are by far the most popular and biggest covered call ETFs on the US market. So JEPI and JEPQ just chugging along. Their distributions have, JEPI is remained pretty stable the last couple of months. Of course, the less volatility there is, the lower distributions will be. That's why you see these big distributions 3, 4, 5, 6 months ago when volatility was very high in the stock market. But another great thing is you'll find out what kind of yield you should expect from JEPI and from JEPQ going forward. So JEPQ, obviously more volatility because it's more NASDAQ centric. So the dividends or the yield is a little bit higher. And the last one here, oh, look at that. They just came out 45 cents, a little bit higher than the last one. And then JEPI, I think a little bit, yeah, a little bit higher than the last one. So really, really awesome funds, guys. So stay tuned for those two videos because I'm going to do a deep dive in JEPI and JEPQ, including solving the equity linked notes mystery. So that's it for the core positions. I feel these are the 6 you could consider core. We'll of course go to SVOL next, which is one of my favorite alternative style income oriented ETF. It's been killing everything. It's been doing absolutely phenomenal. It's been growing at past 200 million. So it's getting very, very, very popular. Really, really nice. You could see the 1-year performance. 9.4 in market price here, 9.49%, much higher than the S&P 500. So this fund is beating the S&P 500. Phenomenal, consistent 32-cent monthly dividends. As of now, I expect this to continue. And some other great fixed income style covered call ETFs, which I'm starting to fall in love with. I like all 3 of them from iShares. So we got TLTW, which does covered calls, slightly out of the money covered calls on the very boring TLT ETF, which is the 20-year government bond ETF. LQDW, which does a 100% at the money covered call on LQD, which is an investment grade corporate bond ETF. When you see investment grade, it just means high quality credit rating. And then this is the one I own, HYGW, which is just your regular high yield corporate bond ETF. Same strategy as the LQD one. At the money, 100% coverage. And one thing I would like to point out is that the April dividends are absolutely monstrous. The HYG one, I mean, this is just, look at that, 85 cents, almost 86 cents, guys. So a big dividend in April from HYGW. Even the LQD one, a lot higher than last month, right? Yeah, well, 46 cents, 54 cents. So definitely higher. And the TLT one, oh yeah, more than double the last month. So I think the more volatility there is with the credit spreads, I would suggest there's some good documentation here. If you go to product brief, all 3 of these have, and you could read what these, here it is, like I was saying, 100% of the strike price, and this one is 102. So the TLTW is definitely your most conservative one, but I would always go with the most volatile one because I want maximum income. That's why I like the HYGW one. But read this nice little article here. Click on product brief on any one of the 3 and it'll explain how these work. They're doing really, really well. Very, very consistent stock price with very, very high yield. So those are some core, really what I consider your core ones, or pretty much my favorite foundational ones on the US market. Which ones you choose or which ones you decide to put in your portfolio are really up to you if you're American, but I feel these 4, 5, 6, 7, 8, 9, 10 are really, really good foundational ETFs. Of course, you don't have to take all of them. You could pick and choose. Now for the more niche ones, you have the Yield Max. Of course, we have OARC and TSLY, which, in case you missed it, please watch the video where I do a deep dive into these. These are relatively new, and I talked to the fund manager himself, Mr. Jay Petruccelli. These are definitely the highest, the craziest, highest yield ones, and they are getting more and more popular. Oh, this is the guy I speak to, Mr. J. Very, very nice guy. He's the guy who manages the options, who actually writes the calls on these funds. Very, very, very high yield. And by the way, their monthly dividends or monthly distributions, rather, somebody corrected me and said it's not a dividend, it's a distribution, and they are 100% right. If you care to look, you just click on this and you can actually see when the dividends are going to be declared. So tomorrow we will find out what the new Tesla or TSLY and OARC dividend are going to be. So keep your eye on these. There's a lot more coming from this brand, Yield Max ETFs, and I do have the intention of speaking to Jay again and keeping you guys updated when the new ones come out. So these are very, very high yield. I consider these more niche secondary positions, not primary, but that's just my personal opinion. Moving on to closed-end funds, of course, we have the most controversial, hated or loved closed-end fund, CLM, which is trading at a 15% premium, which is lower than usual. Usually it's over 20% premium, but I would say let's wait because typically they do their annual rights offering in April. Last year they did it on April 8th. You see, they announced the rights offering on April 8th, 2022. So maybe they're going to do it, maybe it's gonna be released in the next couple of days. And what happens is usually it puts a lot of pressure on the CLM price because this is a dilutive offering because they typically offer the shares less than the NAV. So expect a CLM video soon, guys, where I will be explaining again CLM in detail because now I fully understand CLM and how it works. I will be explaining to you the 5 key things you need to understand to master CLM and the things you need to understand before investing in CLM. So stay tuned for that video and let's all watch the rights offering. When it comes to the all-in-one all-in-one closed-end fund solutions, you have 3 of them. You have YYY from Amplify ETFs, and like I keep mentioning, these are ETFs or funds that have a lot of closed-end funds inside of it. So just like I don't like to pick covered call ETFs, I like to have an all-in-one solution. I don't like to pick closed-end funds either. I like to have an all-in-one solution. So you have 3 of them: YYY, RIV, and CEFD. What's special about YYY and RIV is that you can actually see the closed-end fund discount or overall discount percentage that you're getting, which for me is always been the most interesting part of closed-end funds. When I'm talking about discounts, guys, I mean, this is trading at a 15% premium because the price is 15% higher than the actual intrinsic value. But a lot of the time on the closed-end fund market on the US side, which is absolutely huge, it was like 400 plus, a lot of closed-end funds trade at discounts. So that's where it gets interesting. So if you scroll down here, this is the most important thing. The average closed-end fund premium or discount. So right now you see minus 8.86%. So that means that on average, the 45 closed-end funds that are in here, that are in YYY, on average, you're trading at an 8.86% discount. So that's very interesting. And then on RIV is, YYY is actually an ETF, but RIV itself is a closed-end fund. So RIV itself is trading at a discount right now, 7.8%. But if you look in the fact sheet, you want to know what is the average discount of the closed-end funds inside of RIV. It's 13 right here, 13.8%. So this is definitely the most important stat when you're analyzing, in my opinion, an all-in-one closed-end fund solution. Then you have CEFD, which is just an index of over 100 closed-end funds. So unfortunately here we can't really see the discount percentage, but it's more of an index one, whereas RIV and YYY I think are a little bit more actively managed. But I personally own both RIV and CEFD. I would say YYY is more your basic option, but completely optional, guys. If you don't like the closed-end funds, you don't really know how they work, I would suggest you don't really need them anymore, to be honest. But again, like I said, the most interesting thing about closed-end funds is always that trying to get them at discount. So that's pretty much it for the overall US market. I would say nothing really stands out too much to me. If you're asking, well, financials have taken a hit, what do you suggest for financials? Well, I would say the only really covered call financials ETF that I know of is really FYLG, which is from Global X. Did go down a few bucks a little bit, so the yield is a bit higher, but this is one of their half ones because it's a G, it's not a D, which means they're all only writing covered calls on 50% of the portfolio. So think of it like a half income, half growth. So if you're American and you're an income investor and you want to capitalize a little bit on the weakness of the US financials, FYLG is really the only one that I know about. If you guys know any income oriented, remember it needs to be like an income oriented, financial specific or covered call specific ETF on the US market, let me know. But as far as I know, I only know of FYLG. So you could pick it up. It went down a few bucks lately. I think it was like 24, 25. Now it's at 23. But the yield, you're going to expect about 6% yield because it's only covered calls on half the strategy. And again, keep in mind, stay tuned for the Global X videos coming out where I will explain QYLD and even FYLG, even the half ones, because they're very easy to understand. They have the same strategy across all their covered call ETFs. So that's it on the US side, guys. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor. advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.